Hi everyone. So today we will understand what is the trade receivable turnover ratios. Okay. So we will understand trade receivable turnover ratios. Turnover ratios. So first we will understand what is this ratio, meaning of this ratio. So basically meaning of this ratio is first all the turnover ratio indicate that how many times in a accounting period one asset entered into the businesses and convert into the sales or revenue, and that's how the same logic or purpose will apply over here. So receivable turnover means how many time in a accounting period your receivable will convert into the cash. Okay, so what this ratio indicate that number of time the receivable are turned into, over converted into the cash in a accounting period. So it is very simple. Okay, so if you're higher your turnover ratio, it means it is good that you are making sales and it will go into the receivable portion, and then from receivable it will hit the cash ratio. Okay, so higher the ratio good for your businesses. But one thing you have to calculate or you have to keep in your mind that whenever you are calculating, the debtor or the trade receivable for this formula, you have to keep you have to take the amount before making any kind of the provision for doubtful debts. Okay, so let's discuss first the formula how you will calculate this ratio. So what is the formula? Formula is basically credit revenue. Okay, net credit revenue, revenue divided by what we will divide average trade receivable, average trade receivables. So you can understand that why we have taken over here receivable, credit sales only, because the sales which is we made on the credit basis will go into the trade receivable. Okay, so if we take complete sales, cash sales also, then it is not fair and it will not give the correct picture. So that is why if you are calculating trade receivable, so here first you have to take the credit sales number one, and second average trade receivables. So credit sales you can identify easily from the books of account which one is the cash sales and which one is the credit sales. Average credit, average trade receivable is simply opening plus closing trade receivable divided by 2. You can identify the average trade receivable, and this is how you can calculate this formula. Okay, what is your inventory turnover ratio, this trade receivable turnover ratios. But one thing here, keep in your mind when you are calculating this opening receivable and closing receivable. So these are the gross figure basically. So you do not have to suppose in your balance sheet 100 is the receivable, while in this 110 you have made provision. So net receivable position is 90 here, right? But here at the time of calculating average receivable, you have to take this 100. Okay, in the similar way you have to calculate for the closing receivable also. Okay, so as we discuss that more this ratio more beneficial or useful for the entity, because the purpose here we are calculating that how many time if a entity making sales, then sales will go into the trade receivables or debtor. Okay, trade receivable or debtor you can say, and from debtor it will convert into the cash. Okay, so this is the complete cycle, and if this ratio is high, higher side, it means company is making sales and that is going into the debtor, and immediately, within some days it will convert into the cash. Okay, so when you are calculating this ratio, suppose your sales is 100 and average this debtor is 20, so your ratio is coming 5. So what does it mean by the 5? What do you understand from this 5? So this 5 means in a year or in a accounting period, this entity is able to make sales, credit sales into the cash 5 times. Whenever they are making sales, it is, in the good condition company is that whenever they are making sales, they can convert cash very immediately. Okay, so they are in a whole year they can convert that particular cycle 5 times. So this is very good. Okay, and if you want to convert this ratio into the days, then what do you have to do in a year? Suppose here 5 time or 4 time you came to know, right? But in a days, if you want to calculate that, okay, in this trade receivable turnover ratio, you want to know in how many days it is coming. Okay, how many days you are making sales to debtor to cash, how many days it takes to your company. Then what do you have to? You have to do simply month or year. So for example, we are calculating for year. So in a year 365 days are there. Okay, and what is your inventory turnover ratio? Here you calculate 5. So if you divide this, then this 73 days coming over here. So 73 days coming over here means for this entity, if you buy, if you make sales, then it will take 73 days to you to convert this into the cash. Okay, so at the time, suppose in the January you made sales, in the Jan you made sales, so Jan plus 73 days, you will have to receive this amount by April. Okay, so why management calculate these ratios? Because management wanted to know that okay, liquidity is a very bigger challenge or bigger issue for the higher management, CFO, CEO. They wanted to know the liquidity positions, because liquidity is something where business run. If the business face the liquidity issue, all the activity will get impacted. Your production will get impact, your operation, your marketing, your administrations, your accounts, all the sector or all the department will get impacted by the liquidity. And that is why higher side management always try to find out or try to figure that okay, what is current positions, and if they wanted to improve the things. Suppose here 73 days is coming. Okay, suppose this is coming 105 in one of the example, then this is very critical for the management, because management know that in a year we are making 3 time revenue to sales. Debtor is taking a lot of time to pay. It means debtor is not paying, either we are not able to collect, or we have given them some kind of the excess leverages. So here management wants to reduce these days, maybe 90, maybe 80, maybe 70. This is depend upon the management. Okay, so this is the logic or reason behind to calculate this trade receivable ratio. Hope you guys understand this thing. Thank you very much.